Hi everyone, Jim Ewing, here with a few thoughts about current financial conditions. Given the equity market rally that has been so powerful over the course of the last 50 plus days, that has levels within close proximity to all-time market highs, with all that's going on in the country and all that's going on in the world, with so much uncertainty about the spread of the virus, the reopening of the economy, whether or not consumers and businesses will spend money the way they did before this all started. With the election around the corner and not knowing if the results will be positive or negative for the markets and the economy, you can't blame investors for being a little confused as to what's powering this market rally, whether or not they can trust it, how lasting it'll be, and what that means for their portfolio. Should you be rebalancing at this time? Should you be adding risk? Should you be capturing profits and de-risking? All great questions. First, let's look at what's behind the market rally. There's a saying on Wall Street, don't fight the Fed. What does that mean? The Federal Reserve System has stimulated the economy together with Congress to the tune of several trillion dollars, not billion, trillion dollars, which is an amazing amount of money to now make its way through the financial system. Some money as stimulus payments are going to individuals, going to small businesses, going to banks. Money is backstopping money markets. We're ensuring that credit markets are flowing. Even junk bonds are being bought by the Federal Reserve. So that's an incredible amount of action and amount of stimulus in a very short time frame, with so little that can be known about the timing of the reopening of the economy and how long it'll last and the safety of it. You can't blame an investor for not knowing if you can trust what's going on. Well, when the Federal Reserve didn't just stimulate with these various programs and the stimulus programs from Congress, they also reduced interest rates to zero. When interest rates are zero, that takes all of the interest yield that can be earned. While it makes it easier for people to borrow money, unfortunately, it also takes the return away from savers. People that would keep their money into a savings account, a checking account, a money market, a CD, savings bonds, all tied to interest rates. So when interest rates are zero and you can only earn between 0 and 0.5% in cash, that's not good enough. So people start to look to invest their money a little longer. Well, when interest rates are zero, that also impacts fixed income or bonds. Right now, a 10-year treasury bond can only yield between 0.5% and 0.9% or so. And that, again, isn't going to help an investor keep pace with inflation. So if you can't keep pace with inflation, you're not really earning any money. That's why you hear the word TINA. There is no alternative to equities. That's what that means. So people that ordinarily would have more money in cash, more money in bonds, start to put more money in stock. So first, people are comfortable taking more risk because the Fed's got their back. Second, there is no alternative to equities because if you want to keep pace with inflation, you need to put money into the stock market. And third, there tends to be an impact or a phenomenon called FOMO, the fear of missing out. When people see the market go up, 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 day after day, week after week, if you had been sitting on the sidelines waiting for the market to dip back down, at a certain point, it can put pressure on the investor. And an investor that otherwise could be disciplined might lose their discipline and buy into the market, even though prices are quite a bit higher than they were just 5-6 weeks ago. So there's a lot of powerful lessons in this, and some of the most tried and true investment strategies work really well in this time. One, be an investor, not a trader. No matter how tempting it may be, don't try to time the market. If you keep your portfolio invested, then you didn't get hurt during that terrible month of March. And you saw your market value come roaring back over the course of April and May. So it's a great message to stay invested and invest towards your goals and know your risk tolerance. If you're not sure about your risk tolerance, please talk to our team. We'll be happy to walk you through it, to have a conversation, a call, or a virtual meeting. We have software, we have tools that can help approximate what is a normal risk reward scenario for a diversified investor. And by discussing it, we might be able to find out whether or not your portfolio is truly in line with your risk tolerance and whether or not you're situated the way you should be for what comes next, no matter what comes next. Lastly, if you have excess money on the sidelines and you've been wondering if now is the time to invest, know that it may not be. One of the better strategies to utilize over the course of your investing career is dollar cost averaging. People do this all the time through their 401k, their 403b, maybe how they save money for a college education for a loved one. By putting the same amount of money in, week out, paycheck in, paycheck out, month in, month out, as you can, it takes some of the emotions out of the investing process, and it allows you to just invest for your goal, whether markets are high or markets are low. That discipline of always investing the same amount tends to work itself to a positive over time. You tend to be able to average in what price you paid for your investments as you go along. So if people add a lump sum to their portfolio today, we're most likely going to average their portfolio in over the course of a number of weeks, a number of months, or a number of quarters, depending on their particular needs. So if you have any questions about that, by all means, reach out to me, reach out to a member of our team. We'll be happy to help. I hope this was helpful. I hope it answered a few questions you might have, gave you a little bit of perspective, and be well. And we wish you the best to you and your family and your business. Thanks so much.